before we go to the next question, because this was also quite popular, is it fair to say, because I just love some definitive markers, and maybe that's my fundamentalist inside me, because I used to tell people like, oh, we want to buy our first home. I'm like, all right, well, don't bother calling the mortgage broker until you've got 10% of the purchase price. Like, because the reality is, unless you have a parental guarantee, like you need at least 10% saved. Now, the world has changed a bit, and Rach, you're looking at me, so do you want to refute that? But I just want some, like, okay, some fundamental things. You've got to try and get out of consumer debt and at least do the Glenn James spending plan, and at least do not be living week to week. And, you know, you've got to really focus on your personal cash flow and spending. Because if you want, there are so many people in our Facebook group that they write, hey, I just purchased my first property. It's an hour and a half out of whatever town. Actually, Azaria, a good friend of the show, she used to host our Gen Z Money podcast. She's a single lady. She's in her 30s. No, she's not. She's in her late 20s. Don't call people lady. It's too old. But so Azaria, she bought her first unit. She's single. Got a good city income, but it can be done. And this is why we need to just encourage you. If you want something that bad, it's going to be sacrifice. It's going to be a season of focusing, and it can be done. So any final kind of points on that before we get to this other?
Yeah, look, I think you've got to have some sort of motivation to do something in life, don't you? And if it is buying your first property, if you are going through consumer debt and you're trying to get rid of that and you maybe haven't got a savings plan together, I'm not actually against going and speaking to the likes of Rach and saying, well, okay, this is where I am. I'm owning this. I'm trying to get on top of it, and these are things I'm doing. But what's possible for me? What do I need? What sort of deposit do I need? And
set up some train tracks for me.
Yeah, this is my income. And all of a sudden you've got this whole vision board in front of you that says, wow, this is unreal. As opposed to saying, well, once I've paid my 20 grand of consumer debt, now I'll go and do that. But in the meantime, it's been a slog. I don't know. You're always looking ahead for me to get some motivation, some inspiration internally.
So do you talk to many people? They're like, oh, we want to buy a property. Can you at least give us a savings target if a parental guarantee isn't available?
Absolutely, we do. So I would say our brokers would talk to people who are at the start of their journey. So it could be that they are getting rid of a few consumer debts, they're starting to save, and they're deciding what to pay off first. So it might be a little credit card, and then they've got their help debt and a car loan. They actually want to know what's actually the most effective to pay off first. Then how much do we need to save? Because how hard is it to start a big journey and a goal if you don't even know what it is? What are the goalposts? How much do I need to save? So even if it's a plan to save for 6 months or 12 months, you still need to know what that figure is. And I think it's a lot easier to go about the journey of getting ready if you have spoken to someone you know exactly what you're going for.
Yeah, absolutely. No, there's no doubt about that. And I think everyone's different in the way they go about it and the way they draw inspiration to move forward as well.
Yeah. And I can't tell you how many listeners of the podcast that we've spoken to that have said, we're actually calling you a year before we're ready, but we heard you speak and we just want to have a bit of a chat, a bit of a discovery call. And then after a conversation, they actually find out they're not as far off as they thought. There are other things there that they didn't know about, and that might be different government incentives that they weren't aware they were eligible for. Or it could be, oh, well, my parents thought a parental guarantee was this. They didn't actually understand that it was this. So, there's other things that are uncovered along the way.
And that's it. Like you asked me this morning when I was up on a ladder trying to concentrate and set up lights, you're like, what do you think of the government equity,
shared equity, yeah.
And I'm like, well, not every product or not every solution is for everyone. Now, if you speak with the broker and they're like, oh, hey, this could be a good thing, you need to know that you can't knock down 3 walls and, do some renovations and all that. But I just think you've got to use all the tools available. And, we are recording this and we'll ignore any of the election announcements and whatnot, because this episode will go up after the election. And we really just want people to, I don't know, just make sure you're well informed about the options that are available.
So Rach maybe needs to set up a hotline, 1300 help me, for people that are 2 years out, 18 months out, that, well, not even, they don't know where they are really. Like, and I know you're not a total charity, and it's an exaggeration, but I think you're right. Like, talk earlier than you think you need, because there may be answers that you're not seeing right now.
Well, that's why we do that discovery call. It's 15 minutes. It might be a year out before you're ready, but you're not wasting anyone's time for 15 minutes just to have a chat.
I will proceed to go to presentation mode. Here we go. How the First Home Super Saver Scheme works. Look, as I mentioned, it's one of the best kept secrets, and we don't like death by a PowerPoint here. So, some of these slides are just to...
It's probably Canva anyway, is it?
Well, it is a Canva template, but all the content's ours.
No, what I meant as opposed to PowerPoint.
True. That's when you know you're old, when you say PowerPoint. Anyway, we'll move on. Basically, the First Home Super Saver Scheme allows you to make voluntary contributions into super above the employer super guarantee and later withdraw those amounts plus earnings to help you buy your first home. You benefit from the lower super tax rate of 15% compared to your personal marginal tax rate. And what I want to plant is, later on in this video, Vince, I'm going to show people a little secret that could be worth knowing, but I'll just save it for there because...
Is this called teasing the hook?
I think it is. So look, ordinarily, and this is where I've got my diagram, normal home savings, and this is just a lay of the land if you are new to money, new to superannuation, new to any of that stuff, you get paid your salary, you pay tax. Now that tax will be over 30% if you're earning more than 45K. And then that money goes into your bank account as your net pay for living expenses. And then you might have another goal of home savings, and you've got a traditional savings account in your name. Mm-hmm. The employer contributions of 12%, they go into your super fund, and the super fund automatically takes 15% tax.
Yep.
So we've agreed that's the basics of, without First Home Super Saver Scheme, how we save for a house. Now, there could be a supplement here, Vince, that quote-unquote savings account could be a share portfolio.
It could be.
It could be a term deposit. It
could even be some Bitcoin.
I was about to say, it could be BTC. So you might be getting a home sooner or
a TAB account.
Yeah, or later. So that's the general concepts there.
Or cookie jar.
Now, using the First Home Super Saver Scheme via salary sacrifice, you'll note here that under this salary thing, we're actually sacrificing our first home savings into super. So you can see this home deposit account is within the super circle. So we are paying 15% tax on that savings.
So instead of putting it in your bank account after your employer gives it, you're just going to tell your employer to give it straight to my super fund and I'll get it later.
Yeah, absolutely. So that's a really simple way. Now, there is another way that you can do this if you're, I don't know, you could be self-employed, for example, and you want to keep a bit of a cash buffer throughout the year. And then in June at the end of the year, or you could listen to this now and be like, oh, I'm listening to this in June and I'm saving from my first house. I might put $15,000 in right now because I can't turn back time and salary sacrifice. So what you can do, you can put an amount from your savings account in the back door, we'll call it, of superannuation and claim a personal contribution on that. And then the super fund takes the 15% tax, and that money that you put in will be tax deductible on your tax return.
So economically, it's broadly the same thing.
Yeah. So there's just two roads into Rome.
All roads lead to Rome, don't they?
They do. I think for the sake of this, Vince, I want to keep it maybe a bit high level. Can we just maybe assume for everything we're going to talk about now, for the First Home Super Saver Scheme, is a concessional contribution?
Yes.
Because you can use
You can.
a non-concessional, but this is a broad tax strategy
and the
more than anything.
The benefit of doing non-concessionals is pretty marginal.
Yeah.
It works, but you're better off focusing on concessional contributions.
So-
And obviously there's a limit on those.
Yeah, so we'll do that. So effectively, that's right there. That's the three ways things work in this world. Normal savings account, you can do salary sacrifice throughout the year, throughout each pay cycle, or at the end of the year, you can make a judgment call and say, I'm going to throw in $10,000, $15,000 into super. Now, it might be a good time to jump in there and say the total amount that can be used in this scheme is $50,000. However, the limit per year is
15.
Yeah.
And it's still subject to the overall limit of 30,000 in a year for concessionals. So if you're a high earner, a very high earner, and your employer contributions are already $30,000, well, you're
maybe a bit out of
a
luck.
bit out of luck here.
And because you're
unless
not
you've got
u-
some carry forward ones.
That's right, but you're probably not using this scheme with non-concessional contributions if you're capping out your your CC caps.
Yep.
Which is your salary sacrifice, traditional salary sacrifice.
Especially the cheese flavoured ones.
So ordinarily, when you're ready to buy your house, and we'll get into some practical steps in what order, you have your deposit in the super fund and you put a application to withdraw effectively, and you pull that money out at your marginal tax rate, but a 30% credit is applied. Okay, so that's high level how the world works in flow, basically. You can save in your own name, invest in your own name, knock yourself out in your own name, salary sacrifice, or after-tax personal deductible contribution at the end of the financial year. No more than $15,000 a year, no more than the $30,000 annual concessional cap.
Yep. And no more than 50,000 over a lifetime.
Exactly. One of the biggest things that you need to do, and this is the problem, John, if you are wanting to buy your first home or an investment property, you could put an offer in on something. You might get rejected for the offer, but you may have to spend some money on doing some due diligence before, and it could just be a big waste of money. So one of the things is when you find a conveyancer or solicitor in your area, or I'd imagine it should be state-based, make sure or just ask the question, hey, what's the cost for your conveyancing fees? And they could be like, it's $1,500. We'll look through up to 4 properties. Because they know that you put an offer in on something, you'll want the lawyer or conveyancer to read through it to give you any red flags. Then your offer then gets declined, or it's, there's a big red flag here, so don't go ahead with this. We don't want to spend $1,500 a pop, but there are conveyancers that will allow, a handful of purchases.
Yeah, you might be able to look over a few contracts as long as you then end up proceeding with one. Otherwise, you will get charged regardless. But yeah, I think the key is, like any due diligence of dealing with the right professionals, they need to have experience in this space, because it's very different to reading over a Torrens title contract, for example, and extend that to insurances. A lot of, or not a lot, but some insurance companies don't cover or specialise in strata, so you need to cover off on that.
So one of the, if not the most major thing that you need to do if you're buying a property in a strata plan, you need to look at the minutes of the AGM. So how that would go is you would ask the real estate agent, hey, can you please provide the last 5 years or as much as possible strata report. So they would go to the strata report company and they would basically have a big fat PDF. These are all the minutes of every meeting, every AGM over the last insert time here. And those minutes, and this is where I want you to pay attention, those minutes will, number one, it could cost a couple $100. Could be a fee involved.
Yeah.
Then what you need to do, you need to go through those minutes with a fine-tooth comb, or even just put it through ChatGPT. I put a 400-page strata document in chat the other day and said, can you have a look at this? What are the red flags? And
Wow.
it was amazing. So AI, while it's crap to say, oh, calculate this financial projection and all this, and it hasn't picked up that the tax rates are wrong or the things have changed, with extracting information out of documents, it's fantastic. So get the strata report, upload it to ChatGPT, and ask for a TLDR strata report, and tell them and it will say what the unit number is, but just be clear with it and say, unit, I want to buy, lot 36, or which could it could be unit 5. Lot 36 could be unit 5. So just be clear on that and say, I want to buy this, and then ask it, what are the projected for the first 5 years of being there based on this annual report, what I'm up for in terms of fees. And it will just tell you.
Yeah.
Ask it, are there any red flags? Are there any special levies? And so you do that in concert with reading through the minutes yourself to see. But one of the big things that you're looking at, I'm doing all the talking as the property guy, aren't I?
You're doing well.
One of the big things to look at, John, is there meat in the sinking funds?
Yeah, and just being on the ground, especially if you're living in it, you've got to ideally get a chance to chat to some of the owners within the complex. Like it's like talking to a local hairdresser about a town, isn't it? So you can pick up so much general information that the minutes may not even account for.
Yeah.
So it's just all part of that due diligence is looking at the minutes, looking at the sinking fund, looking over the contract fine-tooth comb, but then doing the numbers and say, well, okay, age of the building and pest report, what does it all look like for me to make an informed decision? What can I forecast for?
What you would do as well, looking through that, you'd want to know, are there any units in arrears? Is there any litigation? Are insurances up to date? These are all just questions that you can ask ChatGPT. One other thing you need to do as well, so we are recording, July that we're recording this. If you requested a report and it said, July, and they give you the report, it was $300 or whatever it is, and you see that, the next AGM is August the 1st, or today, but it's not in there, we're pressing pause and waiting until that AGM and then getting a copy of the minutes. I've seen that in 2 of the units that I was helping do some DD on with my friend. We had to go back and request the AGM minutes because it wasn't in the bundle or it was happening the next week or whatnot.
Yeah.
So you just have to check that. But one of the biggest things that stood out was the amount of units that were maybe 15, 20 years old, which maybe you would say would be newish compared to a 70s or 80s build, that the that the sinking fund was in deficit, literally negative, because no one was contributing.
No.
A whole heap of investors had bought all these units, never paid their levies.
Yeah.
There was litigation to people that had outstanding money because if you don't pay, you'll get a late fee. If you don't pay, there'll be interest accruing, all this stuff. There was one committee that there was litigation against the committee for not doing DD or not running the scheme, like some pretty wild stuff.
Yeah. So your conveyancer would pick up all of that generally.
You'd hope so, but because you can request the report yourself and run it through chat.
Yeah.
And this is the thing. If it was a good deal, and we'll just say it was $600,000, for example, and it was, I just wanted a 1 bed, a 1 bath, and it was fine. Knowing that there is a special levy that is $5,000 or $10,000 a year for the whole complex over the next 5 years, so $50,000, you can just ask ChatGPT, what is my best, most likely, and worst case exposure financially to this levy?
Contribution.
And if you know that, well, sure, if there is a $60,000 special levy, I might only be on the hook for $3,000 or something like that. That's not scary because you understand and you can just factor that in because it's a good location, it's newish, it's fine. The rest of the building isn't in deficit. But the red flags are, and the area that we were looking at was around Epping. I shared one a few months ago on the podcast where, $300,000 paint job or something like that, and there was no money.
Yeah.
And another one, there was not one owner-occupier in the building, which isn't bad because people have to rent. But the bad thing was all these investors bought all the units. 15 years later, they were selling for less than what the investors paid for them. And the investors are just trying to offload these, but they still owe money to the strata committee, like total mess.
Yeah, and I think there's a whole string of events there that lead you to making these good decisions, and that the owner-occupier versus investor ratio is really important from a wealth creation point of view as well, because as you mentioned, the investor doesn't put time into money into the complex like the owner-occupier does. So they'll keep the cosmetic improvements up, whereas the investor will be bare minimum sort of thing. But I think the one, well, there's plenty of red flags to look out for. But if you're looking at it from a how can I live in this comfortably? Another one that you need to look at is who was the builder and who's the developer. If it was in the last
5.
Well, probably 10 to 15, to be honest. If they're not still around, we can go and that's maybe a concern for a start. But also go and check out what other products they've built that's older than the ones I'm about to buy, and just see, do they look dated? Have they had any problems? Again, try and talk to people, etc. And you get a pretty good feel for what you're dealing with. And there's when it comes to developers and builders, there's the good end and the bad end. And you don't want to be struck on the bad end because the problems just keep mounting up.
Yeah, so for my friend who's like literally looked, I think we've put 4 strata reports through and all of them were rubbish in terms of these strata schemes in the Ryde area.
Yeah. And you also look at the vacancies in those areas and
Yeah.
concrete jungle, like concerns.
So my friend, she has resolved that it probably will be an older unit, even dare I say red brick type, 80s build or whatever that was, maybe older, smaller, and there has been some promising signs in terms of the financials of the strata committee with an older unit, and she will recarpet it and redo the kitchen and get on with her life.
Because it's simple.
Yeah,
it's
and
basic. There's lots.
3-story, no lifts.
Yeah. Small numbers in the complex, all those sort of things.
Yeah.
But older and uglier. I think older and uglier with units, more often than not, better than new and glossy.
Yeah, because you don't get, warranty per se.
No.
With your new unit, like there could be some defect periods and all that. I'm probably not in this climate buying off the plan to live.
It's a lot more questionable than it was maybe 2, 3, 4 years ago.
Yeah.
And I think the uncertainty of it, there's no better time, and these are actually coming out of my mouth, Glenn. There's no better time to buy units than in the last 10 years than now.
Right. Why?
Because of that supply demand.
Right.
And the fact that affordability for buying houses in chosen areas is an issue, right? The Ellas of the world are saying, I want to live in Brizzy, I want to live in a good suburb, but for me to buy a house, it's going to cost me 1.4.
Yeah.
I've got 700, I can buy a 2-bedroom unit. I'm in every day of the week in that particular suburb.
Is it, so if there was a strata plan and there was a 5-story unit complex in West End or something like that, is there a report you can do for the building to see if there is owner occupiers or investors only?
Yeah. So when you look on CoreLogic, you basically see how many's in the complex,
Right.
and you can see the ownership. So
Right.
it's either saying owner occupied or tenanted or government housing or whatever it might be. So you can check that. And you can just manually do the numbers. Say, righto, looks like there's 70% here based on the numbers that I've done, right? But we're looking at, like I was having a conversation with someone in Sydney who's looking in Maroubra, right? There's the difference between the house median price and the unit median price. How much do you reckon?
Oh, it'd be a million, wouldn't it?
1.9 million.
Jeez.
So I can never afford to buy a house in Maroubra, but I've got half a chance of buying a unit. Same thing in Miranda near Cronulla. $1 million difference between a unit and a house. So that gap is going to narrow.
But you're not saying it's a good time to buy a unit as an investor, but more if you want to buy it to live in.
Well, there's an argument for as an investor as well, because that gap is going to narrow. It has to. But when you see a house and median house price and median unit price only $200K difference, then yeah, you try and buy that house. But yeah.
I mean, there's a lot here, but all I'm saying to the Ellas out there, you've got to kiss a lot of frogs, and you will look at a lot of different units. Try not to get unit fever. If it doesn't feel right, if you've got to force it, don't try and justify, oh, well, there's a special levy, I think I can pay it. Like, if it doesn't, like, there's units everywhere, but be very, very strategic with, I want to, as a minimum, 2 bed, 1 bath, or 1 bed, 1 bath, whatever that is. For me personally, studio apartments, not ever buying one to live in or as an investor. Just not doing it.
Well, lending becomes an issue.
Why is that?
Essentially, banks don't like too much under 50 square internal size. So if we've got that, we're buying something that's 45 square because we want to be in the blue chip suburb, you can get lending, but you might pay a premium for it, or you might have to put in 30% deposit or more.
Yeah.
So just be wary of that.
And then I guess the only other kind of bank risk is if there was some suburbs like Mascot in Sydney where some banks and lenders won't lend to a tower because they've already got too much exposure, too many of existing customers.
Yeah, and go further again on that and say, well, they might not lend to a postcode.
Yes.
Because they're already exposed overall in that particular
But your mortgage
postcode.
broker will guide you through that. Reach out to Sphere Home Loans if you need to. Look, there's a lot of doom and gloom, but it's not bad to own in a strata complex. I do. You do. Well,
You've just...
by definition, you do with
by definition,
our
I
other
do. Yeah, I'm
place.
just thinking about that.
Yeah.
But yeah, so you're right. Like, there's probably just that next layer of due diligence that needs to be done that probably doesn't need to be done as strictly with a house, right? There's still obviously red flags with houses as well. But yeah, absolutely not the end of the world to go and buy strata. Absolutely not. And I think there's massive upside in the next 5 years. But just know that you're asking the right questions and ticking the boxes that we've spoken about today.
And, you know, if you go to an open in a unit in Brisbane and there's 15 parties there looking and there's a 20 grand special levy that's levied and your exposure could be, or we'll go more extreme. There's a hole in the sinking fund or there's a special levy and it's black and white all day long that you've got exposure here to maybe 20% or more.
Yeah.
Oh, sorry, $20,000 or more you're going to be on the hook for. Sure, if there's 15 people there, you might have to suck it up. But there's one person and their cat that's walking through and it's a bit quiet. Off the bat, that 20K, if they want to sell this bastard or they know that there's an issue here, I want to pay less, knowing that I might have exposure up to $20,000.
Yeah.
And then I'll do a deal.
Yeah. No, absolutely. The probably the final piece on that for me would be glossy is not always better. So when you're looking at new, you walk in, you can smell the carpet, you can, in a nice way, you can see everything's done, move in straight away. Beautiful, nothing to be done. No ugly red carpet from the 80s. You are paying more of a premium for that because the condition that it's in doesn't always mean that it's going to be a better outcome from you from a financial wealth point of view. So just have two sides of the coin when you're going in.
Daniela said, would you rather have a small 2-bed paid off in 10 years or a slightly bigger property, more maintenance, etc., pay off in 20 years, no family help incoming in the future? They'll be 48 and 55 in 10 years. 70% of the group said 2-bedroom townhouse paid off in 10 years or a 3-bedroom house paid off in 20 years, 30%. So it was 70-30 down the line. What are you guys doing?
Jeez, what are you doing, Rach?
I actually am on this. I clicked on this.
Did you click on it?
I did.
Oh,
You can see my response on the Facebook group.
Yeah, right. Okay, and you went?
I was probably one of the minority that said 3-bed house.
Yeah, okay, you went to 30.
what would you go, Johnny?
Oh, look, it's all about buying a property for me is wealth creation / lifestyle. So 3-bed I need a backyard, I need space, and I want wealth. So I'm going to 30 as well.
Yeah, I'm probably this is and I don't know if it's a real thing or a hypothetical, but this is one of the things where we have to split up financial decisions from lifestyle decisions. And a 2-bedroom townhouse, and I guess, they obviously don't need 3-bedder, but if you had 3 kids or 2 kids, paid off 2 bedrooms not on the table. Because it's like, you might want to share bedrooms for the kids, but at some point you're going to have to move. So I think I just thought it was a bit an interesting discussion point. But I think if I was in the situation where I didn't need the bigger house, because obviously they don't, I'm probably still trying to do the 3-bed house, but I reckon you'll be able to pay it off. I don't think it's going to be linear, 10 years versus 20.
Yeah.
And these are all hypotheticals.
Yeah, and it depends what you prioritise in life, isn't it? Is it, okay, I can get it done in 10 and enjoy the next 30 or 40, but not have the wealth in that period? I don't know, because, there's no one size fits all. But
No.
it's good,
There'd be a lot of variables to that too.
But most people like the idea of paid off in 10 years.
Sounds like it, doesn't it? It's interesting. And the 2-bed townhouse, whilst it's smaller, it still could have ongoing issues.
Yeah, what if they need a
3-bed house
friggin' special levy of 10 grand per person?
Yeah. And what if the structures weren't... Yeah.
A lot of what ifs, but I just thought it was interesting. Most people says 70% 3-bedroom townhouse paid off in 10 years. But I'm probably going to stretch myself. Actually, it's interesting. When I bought my first home, and this is kind of true when we do stuff for the first time, it can be scary and intimidating. And if we're trying something for the first time, we might not make a bold move. And everyone who's ever bought their first home before, it was really scary getting that mortgage and, committing to that monthly mortgage. But 6 months in, it was just normal, like it was fine. And my old man's quite conservative in terms of, financially, fiscally, I guess, in terms of doesn't spend lots of money. Well, he bought a new gun the other day. He does clay targets and he does all that stuff.
Wasn't for self-defense.
No. And he's got like $7,000 Beretta, like under-over shotgun, 12 gauges. Yeah, he's really into it. But anyway, he said to me when I first bought my house, my first home, at the time I was really scared because I had to kind of stretch myself and the interest rates were cheap at the time. Him coming from an environment that was like 17% interest rates back in the day, he said to me, because I remember the rate was 5% when I got my first loan, he's like, borrow as much as you can for that cheap money and just stretch yourself. And the house that I bought, when I did the walkthrough in open, I'm like, I don't know what I'm doing here. It's too expensive. It's nice. Anyway, ended up getting that one. And I'm glad I did stretch and push myself. So I think just some encouragement. If you are doing something the first time, it might be your first home, and you do have the means to stretch yourself a little bit. I think a little bit of financial stress in the right department could be good. And we can unpack that more because I think we need to assume that we'll make a scenario up. You rate your team sees someone, they're like, yep, you can borrow 900 and it'd service no problem. You're looking at 830 homes and you're like, oh, we don't want to go too much and it's scary. I think there is that tension of a healthy stretch if the Mercury and Venus align. I'm not talking about overextending so you can't afford it, but a healthy stretch for an asset that's going up in value, you might end up spending less on shat you don't need in your life. And I don't know, what do you guys think about the healthy stretch?
I start again. I did
Having a stroke.
I did an interview with a guy who'd been in residential commercial real estate for 100 years, right?
Awesome. Good story. All right, next question.
And he was talking about the principal place of residence. Do you want to cut back in?
No, we're going. We don't edit anymore, Johnny. We're doing entertainment.
Glenn's been a knob over here.
Ray just lost it.
You're right,
Keep
Rach.
going. Keep going.
Your principal place of residence is something that you're going to stretch to for most people anyway,
Yeah.
because it's your dream home that you live in and you're going to stretch for the next 20 years, and that's why we see inflated prices a lot of the time. So, yeah, I agree, but you've got to make sure that you've got your buffers in place because everyone's incomes are different too. Like Rach runs a business, she wants a pay rise, she goes and gets more clients, right? Teachers, nurses potentially can't go and do that. So there's no one size fits all. But yeah, and we'll talk to that after the break, I think, with a question regards building a portfolio and stretching to that as well.
Yeah. And I
Mindset.
think that's the dance, isn't it? Because on one hand, you don't want this, and I'd seen it when I was practicing on the front lines with clients. I'd spend 2-3 years with them to get out of debt, out of consumer debt, got savings. Then they bought too much house, and then we furnish it and go back into 20 grand consumer debt to get the lounges and all the new furniture. And to me, that's like, well, that amazing kind of blessing of being able to buy a new home and live in it. You're now living week on week stressed out financially again. So I think it's a dance with, I think my comment was when you're doing something the first time, it's scary, but just lean into it just a fraction more.
Yeah.
I think, don't know what you're going to say, but the conversations that I'm been having lately with a lot of people are, I'm spending less because I don't need more, as in I'm only going to buy a 2-bed because I don't need that 3-bed or that house, which is purely a convenience thing, got more time to go and spend with others, whatever it might be, without looking at what's going to make the most money. And this is clearly on this 70%. They're looking at, I'm not worried about too much how much money it's going to make. It's more about my lifestyle.
Yeah. And that's it. And like if they only had one child, they might be fine with a 2-bedroom townhouse. If they got no children, it might be fine. But yeah, I think it just goes back to your values and your goals. Like, what do you want to achieve?
Yeah, and I would always recommend that people have a figure they're really comfortable paying back a week. So many people talk about what they want to borrow, and they've got that figure from the houses in their local area. So, houses are $1 million, so I want to borrow $1 million. And when they actually see, and then you say, well, how much are you comfortable paying back a week? That figure's not in the ballpark.
Yeah.
So, what you can borrow and what you're comfortable paying back a week sometimes are vastly different. But I would also encourage people for that first home to stretch. If it's going to get them a better property, but they need to understand what that repayment looks like, look at their budget. What are you going to give up to be able to facilitate that?
But I think we're in a lending environment now where rates should be pretty stable. Like, who knows? Like, if anything, if the world falls over next week when old mate tweets something, the Fanta Fura, when he tweets something and everything ends, well, if the economy goes down the drain, if anything, rates will come down to stimulate. But if you don't have your job, it's probably ooh. But yeah, it goes back to the buffers, right?
What if interest rates went 1% increase in the next 12 months? How many Australians would be on their knees? And I think that's, to your point, the government is saying, well, we can't let that happen. Like only last week, Totality come out and said there's $12 trillion worth of residential real estate in Australia that's $3 trillion more than combined commercial property, super and shares. Like that's how much of a beast this thing is. They're not going to let it fail.
Yeah. Hey, it's Glenn here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.